Good morning and welcome to the LIONTRUST Asset Management PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to CFO Vinay Abrol and CEO John Irons. Good morning to you both.
Good morning. Good morning, ladies and gentlemen. Thanks for giving us your time this morning to explain a little bit about LIONTRUST, where we are. I will briefly at the start give an overview of what is LIONTRUST, what makes us different, where we believe our strengths are, and then post our half-year results, Vinay Abrol will go through some of the financials for you. So for those of you who don't know, LIONTRUST is specialist fund management company. I've been chief executive for the last 13 years, and over that period of time, we've seen strong growth in assets taken from $1 billion to $33.5 billion at our last published number, and we're now a constituent of the FTSE 250. We focus on the areas that we feel that we can add value to. So we've got 8 investment teams, onto those in a minute, and really our assets are split predominantly in the retail savings part of the marketplace, but we're also expanding subtly with the recent acquisition of Majidi into the institutional space and looking to expand our European footprint, where we have half a dozen people in there. I suppose the core to LIONTRUST is that try to make things as simple as possible. The base tenet of the business is if you've got a good, strong investment process, you're free to manage the money that you want to. We obviously run all the checks and balances against that. But what we're trying to do is, by not having a chief investment officer, to allow talented individuals to manage money in the way that we think is best and appropriate for that. So we drill down very much on process, a lot of discipline in there, from buy, sell, size recommendations to being able to take that long-term approach, not being I suppose affected by a house view or having through risk and is having to come back more towards index performance. So we're very much looking to add value as alpha managers, and I think that in the difficult year that we have had, I think that becomes more and more important, because when you've got a lot of noise in a market and a lot of volatility going around, it's highly important that you have that sort of process and anchor to come back to. You get a lot of short-term movements in stocks, but if you look at the underlying performance of those stocks, you can go back and check, the reason we bought them, is it's still the same in there. And having that ability and confidence to stick with those investments for the long term, as you can see in our results, produces good returns. The other side of that equation is, if you've got a good, strong investment process, we provide a route to market for what you do. And later on, we'll go into a little bit of the strength of our distribution and the brand. So our 8 investment teams are on I2, and the piece there, the largest one's been sustainable and the economic advantage team, which is a UK equity mandate. UK equities, whilst they have been very much out of favour over the last 5 years, that is a team that is to buck the trend and raise assets through that period, and has produced very strong performance across that sort of mid-small cap parts of the marketplace. Sustainable team we acquired just over 5 years ago when we bought the LIONTRUST business. That was a team that has now got a 21-year track record. When we acquired them, it had about 2.3 billion of assets under management, and that's grown now to over 11 billion. With the sustainable side is that if you're looking for areas of differentiation and looking to move forward, this is an industry which historically has decided to either compete on price or performance. Neither of which I'd argue are particularly strong areas of competitive advantage, because price is only as good until somebody is cheaper, and performance is there until somebody performs better. And I think with the sustainable side and what people have seen, with demand for assets there, is that this is very much driven from requirements from clients. We know from our own engagement with clients that we probably get 4 or 5 times the level of engagement with investors on the sustainable side than we do with the more straightforward equity funds. And that's very much based around, if I write to you about the shape of the yield curve, the end investor will tend to switch off. If I write to you about a transition to cleaner, greener energy, urbanization, social mobility, they're all things that investors are interested in. And I think that's quite important in this industry, where historically it's been, it's lacked transparency, it's been very opaque, it tends to use a language which is a barrier to people engaging. And if you think about the industry as a whole, everybody of a working age has a pension. And so we've got, product penetration across the country, yet we've got an industry which has got very low trust in it. I think, what you see from what we try to do on the distribution side, and definitely with the brand, is, find ways in which we can build that trust through clear communication about things that people are involved in. And after all, these are people's savings. People have worked hard to accumulate these points. They want to be able to understand better what's going on and where they are. Slide 3 shows you, the growth of the business. Really, our growth strategy was been along a 3-pronged approach. The things that Elf and the management team and the people inside LIONTRUST, can affect on a day-to-day basis is organic growth. That the first and foremost, that's the most important, it's the most profitable way for us to grow our business. And if you look at, in 3 there, you will see, that those strong net flows that have come through the business. The other side is through what I would call talent acquisition or hiring of new teams. That is, where we can see managers or identify managers externally that we think can add value, would fit in with Ireland, which we manage money. But there is one sort of all back to that, is that a lot of the time, when you take people on day one, they have 0 assets and no track record behind them. So it takes 3 years to get a track record. That's fairly easy to say. And also, you've got to nickel and dime it in the short term to raise sort of the critical asset levels to be able to engage with larger clients. And that sort of brings in, I suppose, our 3rd prong, which is strategic acquisitions. And we use acquisitions not to bolster assets. I think buying assets just to fill silos is a relatively unprofitable way to grow your business. But what we do use them for is to fast forward that grow your own. Like, so the JD acquisition was to give us a broader exposure in both investment trust world and in an institutional space. And you'll see some of our other ones where we're adding either manufacturing, fund management, investment management capability, or distribution strength. And then from there, we're looking at how we can improve those businesses, take them forward and grow. The most successful example of that has been, as I said earlier, with the growth of the sustainable team from 2.3 to over 11 billion in the last 5 years. Around that, it is, we're very much a business that puts the client at the center of what we do. Therefore, our brand is, very important to us. We grow that, and also the way in which we service our clients. I think on that side, on the distribution side, we have a high level of engagement across all the teams with clients. Before last, we had 900 people on just on a a sustainable conference. And on the same day, we would have had 2 or 3 other presentations going on with the other teams. Now, we can put out a lot of output, but the key to a lot of that is the level of engagement you get on the other side. So, those are some aspects we look at to see, what we're sending out. Is it being received? How's it been opened through emails? How's it directed traffic through our website? So we can, tailor and focus the quality of the information that we send out to people to serve them in the best way. Because they're all, we're competing with an awful lot of other fund management groups, and the last thing we want to do is filling up people's inboxes or waste people's time. So it's very much clearly focused on making sure that we understand where our clients' needs are. We spend a lot of time, positioning products for the right types of clients along that way. And I think that it also demonstrated where the sales success is. I'll go through slide 5, but it shows you that where we are, presumably, a lot of output, and how's that recognised. Fund Management Group of the Year last year, we were Institutional Fund Management Group of the Year with Financial News as well. So plenty of awards across the group. We'll move into slide 6. It will show you that, in terms of where we are on competition, we sit in the top 10 of gross sales. I think some 30 million behind Schroders in Q3. And if you think about the relative sizes of the infrastructures, as it we're clearly delivering on that engagement level, and we have products that are appealing, attractive to clients. And again, more where we're seen by intermediaries, voted best by financial advisors on the sustainable side, and high scores in terms of recognition, and eighth in terms of brand of asset managers. I mentioned earlier acquisitions, and I've talked about the sustainable one. I think maybe if I look at 2 of those acquisitions there, Neptune and Majedi, both sort of similar requirements from point of view. Neptune was very much bolstering our global product offering. Majedi bringing us manufacturing strengths in in the institutional world. Majedi had a very strong amongst its client base awareness of sustainability, responsible capitalism, and that was something that we very much wanted to sort of pivot towards in that institutional marketplace, having a very strong sustainable brand in the retail marketplace, but looking at how we could take that where there is still huge demand for sustainable and management, and not an awful lot of successful, I suppose, supplies of it, and therefore the opportunity set for us was to grow more out. But it does show you the difficulty, when you positions. If I look at Neptune, that was a business that we bought, which was in outflows of about 70 or 80 million a month, and we were able to turn those outflows over the next 18 months into inflows and to grow that business going forward. We were obviously able to do that against a sort of benign market background. Majedi, I'd argue, was probably a slightly better run business when we acquired it, but it does show you the fragile nature when you have much more volatility in the market behind. And so a lot of it is very much how we structure that business and position it going forward, and having very much an eye on what we're trying to achieve in the medium to long term. One of the things we look at very much on a day-to-day basis is that I can't tell you in the short term where net flows will be, and I can't tell you where market levels will be. What I can do is, if we do our job correctly, we will come through, as we did through COVID, with a stronger market share and a business in a strong position to gain from, a bounce and an upturn in sentiment. So very much when you have a year where you have a lot of risk aversion, you have clients looking at how, flows and looking at how they shore up their own balance sheets and a degree of uncertainty. For us, it's very much about focusing on the strengths, making sure that we have strength of our conviction to focus, and to maintain our, outlook on and process, to make sure that we're well positioned, for a change in fortunes going forward. And at that point, it's important for me to pause and pass over to Vinay.
Hi there. Hi. So maybe I'll just spend a few minutes going through our half-year results for the 6 months that ended 30th of September, which we released to the market a couple of weeks ago. So in terms of the headline number, in terms of if you look at the P&L in terms of revenues, what is the income that we're generating from management fees? Half year on half year, so comparing the half year just gone with the equivalent period last year, our revenues were broadly in line, so just up a small amount, 0.2% to just under 109 million from 108 million, 108.5 million last year. So revenues broadly in line with the equivalent period last year, so very much on track compared to last year, which was very strong. That actually translated into our adjusted profit before tax. So maybe I'll spend a minute or two on what the adjustments are, but an adjusted profit before tax of just under 43 million, 42.8, up 9% compared to last year. So what that tells you is that we've had good, strong cost controls in our business when you compare on a like-for-like basis compared to last year. We like to use the adjusted profit number rather than the statutory profit number because that strips out some of the exceptional costs that we have, in particular in relation to acquisitions and the cost for accounting for acquisitions. And I'll maybe talk about that in a little bit in a moment as well. So 0.2% up in revenues translated into a 9% increase in adjusted profit and a 4% increase in our adjusted diluted EPS, the earnings per share, at just under 54 pence per share of earnings for the half year. Again, slightly less than the profit number, and that's just reflecting the fact that the Magedi acquisition completed on the 1st of April, and we issued 3.7 million shares. So although the profit number has gone up 9% because you've got a bigger number of shares to spread that profit over when you work out your EPS, it gives you a slightly lower increase in adjusted EPS. Operating margin up to 39.4%, so up strongly compared to the equivalent period last year, and a little bit less than our full year operating margin, which was 41.7%. The full year, if you know us, in our second half, we tend to have the opportunity to earn performance fees, and that does help operating margins. So the guidance to the market is very much that we want to keep that operating margin around 40%. We see operating margin as a key measure of our success in managing our business efficiently. And if you look back over time, you'll see that as our revenues have grown over the last 5 years, we've seen operating margin increase. So what does that tell you? That tells you that actually that we're running a fund management business properly. We are growing our profits faster than we're growing our revenues. So we're not sucking more expense or cutting our fees while growing our profits. So that's what I think you would want to see in a good business. As revenues increase, you'd expect economies of scale and operating margin to increase, and that's what you've seen with us. That has translated into a first interim dividend. We pay two dividends a year. First interim dividend, 22 pence per share. So broadly, in line with the dividend that we paid at the same point last year. The board has confidence. We've guided even though the outlook for the full year is, in terms of the market estimates, are for a lower profit number than last year. I'll talk about that in a second as well. We've held the interim dividend at 22 pence. The market is forecasting 72p dividend for the full year, so a final dividend of 50 pence. per share, which will be payable in August, declared in June when we do our full year results. So again, we have a well covered dividend. So whatever we have been conservative in dividend policy. We've in terms of our adjusted earnings, our adjusted EPS. Last year we paid out 60% of our EPS. Now again, the second half is going to be a tougher half because we're starting at a lower point in terms of AUM than we started the financial year. But we have got scope to ensure that our earnings are not going to be anywhere near where our dividend is. So our dividend is well covered and well supported and pretty solid. Some of the more detailed sort of measures that you need to look at: average AUM up 3%. So our average AUM is 35.1 billion over the year, and obviously it was quite a volatile year. We started the year with the Majetti acquisition, which took us to just over 38 billion, and on the 1st of April, and we finished the half year at 31.7 billion. So you can see that the AUM has fallen in line with the market and flows. Strong average of 35.1, but you can't get away from the fact that we're starting the second half at 31.7. So we expect the second half to be much tougher in terms of revenues, and you see that in market forecast. The good news, is that we've seen a stronger AUM number that we published mid-November when we published our results at 33.5. And again, if you look at the market expectations, a lot of people have that number as a year-end, end of March number, end of March 23 number. So who knows what's going to happen to the market in terms of ups and downs? But we're starting at a low number on the 1st of October, but we're in not a bad place, albeit even 33.5 is below the average for the first half. So it will be a more challenging year. Revenue margin, again, a very key measure. Are we maintaining revenues? By just cutting our fee margin. So are we are we just trying to get more revenues, but we're not seeing revenue grow in line with AUM. So we saw our revenue just tick down a little bit from 64 basis points or 0.64% to 0.62%. That is a revenue mix rather than revenue erosion in terms of us cutting fees. When we did the Majetti acquisition, we told the market the average margin on the Majetti business was 0.5%. It's actually lower than our margin on our legacy, on the LIONTRUST business, which has a focus towards retail. So you would expect that margin to come down as you've got, as you add AUM that's at 50 basis points, 0.5% rather than a higher margin. So we're pleased, and you should be reassured that we are maintaining our revenue margin, in that sort of low 60 basis point level. I'll touch on the impairment charge. Some people have picked that up. If you look at the big difference between our adjusted number and the statutory number, we took a total amortization charge of just over 20.5 million for the half year. A lot, and this is non-cash, so this is not cash paid out. It's just accounting for acquisitions. So off that 20.5, just under 8 million is the regular amortization charge that we take for the acquisitions that we've done. A very quick recap: acquisition accounting is quite complex, but basically when you buy a business, you look at the cash flows that business is going to give you, and you discount that back to a current value, an actual intangible asset that you've acquired, and the balance between what you pay for it and that is goodwill, which goes on the balance sheet. Both go on the balance sheet. Intangible is then amortized, i.e. spread out over 10 years. So that 8 million is that amortization charge for the acquisitions that we've done in recent times. We've taken an impairment charge of 12.8 million, and that is really just a retest at the balance sheet date to see whether the assumptions that we made at the time of the acquisitions, how they changed now for us to test the value of that asset on our balance sheet. So we've done that. Obviously, discount rates have increased, and our original projections on flows and AUM have been, are stronger than we've seen in reality. So we've taken effectively an earlier charge than we would have done. So some of the charge that would have come out over the next 10 years, we have taken now. So it's more timing, not cash. It is some of the peculiarities of acquisition accounting. So it's and I think you'll see that happening in a number of asset management businesses that have done acquisitions in recent times. I'm looking at the value of those assets that they hold on the balance sheet. So balance sheet, the largest balance sheet remains very strong. We have 110 million pounds of cash on the balance sheet, real cash. So we're in a healthy position. If you're familiar with asset managers, we have a requirement to hold regulatory capital. So the regulator wants to ensure that we are operating with sufficient capital to run our business, and they've got various parameters. On average, it tends to work out across the industry around 0.1 to 0.09%. So our regulated capital is around 30 million. So that's what we have to run the business. So we have a big surplus in terms of cash, which is a good proxy for the regulated capital that you've got. So the business, in terms of where we are, is in a healthy position. We are paying out dividends. Those dividends are very affordable for us. We have been conservative in our dividend policy, and I think that's stood us in good stead now. So there's no real threat unless there's a major market correction. Our dividend is pretty secure. So the business is performing well. You can see that with the operating margin, and we will have a tougher second half. Just because where the markets are and where our AUM is. But the dividend is there. Dividend is secure. Around the current, for the markets around those levels. So that's me from the finance point of view. Maybe hand over to John to talk about strategy and outlook.
I think not on too much here, but obviously the 6 sort of pillars or the principles behind LIONTRUST mentioned there, and all the time we're looking to make sure that we've got the foundation correct for future growth. Want to be that responsible investor. After all, what the asset managers do, we deploy the capital that allows the economy to function in its broadest sense. And as investors in companies, we're in a position, to create change and improvement in those businesses. So that is, that's core to our beliefs. We think we've created the right environment for fund managers not to be, drawn by or distracted by sort of short-term volatility, and very much to stick to, long-term investment and the production of, good returns from that. After all, at the end of the day, that is what we stand or fall on in our output. We continue to broaden distribution. Talked about how it plays into institutional and further into Europe, and we've distribution agreements with ABN AMRO and Europe. With SEB in Scandinavia and the 2 others, and those are areas that we look to, to support future growth in the business. Acquisitions, and there is one of the questions on there I didn't see pop up about consolidation in the asset management industry. Will we be a part of it? Obviously, we spend a lot of time looking at businesses. I've looked at a lot of asset managers over the last 20 years. They change size, they change shape, but it's a question of whether they become more attractive to us. I think, from our point of view, we have a very clear focus on what we're looking for, what will add value to our business. It has to have, a strategic purpose. If you look at some of the consolidation that's gone on in the industry and in the areas where it hasn't worked, it's been very much driven by cost. If we put 2 businesses together, we get 100 million of cost cutting out of it. If I put a 13 multiple on that, I've created more than £1 billion of market cap. But if you lead with cost and not strategy and focus, you just whittle that away over the future by having that lack of focus. So for us, it's very much more the strategic rationale behind deals. I think you will see more consolidation in the industry. It's something that's been talked about for years. But I think what's slightly different this time round is that in the past markets, where you get periods where markets go down, companies start to struggle a bit more. Just at the point where you think capitulation will come in, markets go back up and everybody thinks their business plan is working as revenues pick up again. I think this time around we will have a longer, more protracted and I but I see that as an opportunity. I think if you've got the right business model, your business model is current and just a way to go. It's generally, at times of flux where it's easier. Well, it's not easier, but you can gain more market share from things. So I look at it, times of challenges, more opportunity for well-run, well-managed businesses, to move forward with. Branding and communication are obviously very key to us. An awful lot of investment going forward. Businesses looking at how we engage better and how we provide relevant information and to target that to the right investors with the right type of content. And so digitalization of our business will be one of the areas that we look to grow more over the years ahead. And obviously behind all of that is to have a very strong operating platform. And we have that now with Bank of New York that provide, if you like, the infrastructure that business sits on. And that's very key to us because when you make acquisitions, it's about the speed at which you can execute and to get them right, and to have powerful infrastructure like that behind us enables us to make those changes quickly and to get very much on with how we go forward and where the focus of the business is, and not to get caught up, spending 2 years trying to consolidate bits of businesses together where you lose that direction. I think at that point maybe we throw over to questions.
Okay, so you've answered a couple of them on consolidation. Do you want to talk a little about why LIONTRUST will come out stronger, will win, or the winners of the sector?
I think the winners will be companies that have a well-defined plan that they can execute. I think you've got to be able to create that, attract the best talent. I wish I had a magic wand for all the way in which you do things, but literally it's about you get the edge by doing the day job day in day out as best you can, being able to attract the right talent and having a clear goal and focus on what you're looking to achieve. And I think a lot of that you can see through the strength of the brand and the distribution, which punches way above our weight. It shows you how we execute that. And I think going forward, how you communicate with clients and how you build up that trust from what is a low base as the industry will put us in very good stead.
Vinay, we've had a question about buybacks, whether we would consider that.
Yeah, I mean, we look at as part of our capital management program. We look at as our cash above our reg cap grows. We do look at share buybacks. We do look at special dividends. To be honest, even though LIONTRUST is in the FTSE 250, one of the largest 350 listed companies in the UK, we still have we can still be a little bit illiquid at times, for larger investors. So we were quite wary of using our cash to sort of make us more illiquid, actually. So I wouldn't rule it out. If you look back through our accounts, you'll see our EBT has been acquiring shares, which is a sort of a buyback, but not quite a buyback. So to limit future dilution on any share option issuance. But it's something that we do look at, and we do know there are firms out there who've been very successful in using buybacks to increase earnings per share and the share price, like Man Group, for example, although they are significantly larger than us. So yes, definitely on the agenda in terms of thought. I think it's something the board will consider, as our capital resource and cash grows. But there's no formal plans to do any buybacks at the moment. We have the authority. We take the authority every year at our AGM to allow buybacks. So if we wanted to do it, we could do it, but no intention at the moment.
We've had questions about investment trusts. We've obviously inherited a couple of investment trusts in our strategy as well.
Yeah. So just on the investment trust, we had a specific question about Magelli Investment Trust. So we have got two investment trusts at the moment. Edinburgh Investment Trust, which is £1 billion investment trust, where we are the AIFM. So we have we have certain responsibilities as set out in regulation as the AIFM. And we have Magelli Investment Trust, which is a smaller 100 million plus investment trust, which we are not the AIFM for that. We are just an investment manager appointed by the board who take decisions themselves. And that board has decided, they've done a tender. This is all in the public domain, and they are moving to another smaller 400 million pound asset manager and taking a stake in that asset manager. So our role with the Magelli Investment Trust is purely as an investment manager. So we have no direct influence over what we can recommend to the trust or the trust board. So that's a decision they've taken. I think the question is, would it not be more sensible for that trust to merge with a larger trust like Edinburgh Investment Trust? I think that's something the board board of the investment trust should consider.
We did engage with them and we talked to them and we had suggestions for them, but they have decided on a different route. So a question really for them. And with the Edinburgh Investment Trust, obviously much more of a flagship, $1 billion size investment trust, the last year winning, and very much something that the investment trust space is areas we've tried to get it into over the previous 3-5 years, and very difficult to break into that space without an investment trust or the perception of you. So now having things there, it is an area that we will look to grow more in.
Yeah, and Simon, who's sort of Chief Marketing Officer, actually has done a lot of work with the Edinburgh Trust Investment Board in building their own brand and doing exactly what reducing the discount and promotion. So we have a very happy investment trust board there. So
and there'll be a lot of promotion of that Edinburgh Investment Trust next year. So question about kind of the teams really in terms of liquidity and opportunities that the investment teams are finding at the moment.
I think liquidity varies. I mean, obviously in the run up to Christmas, it'll be non-existent. But I think there are opportunities around. We're seeing, the interest of more is, we see companies that have been bid for. It's not quite as much seen as much as earlier in the year, but it will come back where private equity will, try and, I suppose, steal businesses, away from the market at lower valuations. What we do find is we've got a very good dealing team on board, very knowledgeable, well plugged in. So either way, whether we're buyers or sellers, liquidity hasn't to date poses any issues, and occasionally it does create opportunities, a buy side for us to take positions, certainly in smaller caps, which may have taken us longer to pick up.
Yeah, I mean, I think if you look at the product range at LIONTRUST, we have got we have got a very strong position in UK small cap in terms of the size of our funds, and we have, as John mentioned, I think we've got a top quality, award-winning, they keep telling me, trading team who've done who know the market really well. So we've Anthony Cross has been running that UK small cap fund for over 20 years, nearly 25 years. So and if you look at the way he runs his funds, he always carries circa between 5 and 10% of cash to help liquidity in terms of investors redeeming, but also, if there are opportunities to take advantage of liquidity in the companies he holds, he's got that cash to be able to do that. So it has always been, trading in small cap is always tricky, but that is something that we are very experienced at, and have been for a very long time. So I think we are very content in that space.
Thank you very much for all the questions. I think that kind of brings the Q&A part of this presentation to an end.
John, Vinay, Simon, thank you very much for that. And I think you've addressed those questions from investors. And of course, company will review all those questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, John, could I just ask you for a few closing comments?
As you said, we feel that the business continues to be very well positioned. It's, as I said, it's been a more challenging year, but I think the pride of what I get from that is if I go back and I talk to each of the fund management teams, which are on a basis, bruised performance-wise, but very much looking, opportunity set ahead. There's very clear focus on what they're doing and strong beliefs that outcomes will be there. I think the engagement side of the business is strong. The distribution on the close sales is still high. So we've got on it that is to where investor demand is. And we look at I think the opportunity set going forward to grow and expand the business over 5 years, it is very strong.
John, Vinay, Simon, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of LIONTRUST Asset Management PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you very much.
Thanks a lot.
Thank you. Have a good day, everyone.